Good afternoon, good morning. My name's Collete English Dixon. I'm the Executive Director of the Marshall Bennett Institute of Real Estate at Roosevelt University in Chicago. I am really pleased to be with you today to talk about institutional capital, the what, the why, the how, and the why not. I was asked to do this because in my prior role during my career, I was at Prudential in their investment management platform, investing in real estate. And I spent a good long time there watching how institutional capital grew in the real estate space and how it looked to select its partners and the firms that it wanted to invest with and in the real estate space as a way to expand its strategy. So today we're going to talk a bit about what is institutional capital, why would you want to engage with institutional capital, how you can engage with them, and then again, why not? So there is a chat box, and Erica, thanks, I'm so sorry about the lack of sound before. If you have a question, please type it in there and we'll get to it at the end. So what exactly is institutional capital? Bottom line is capital provided by institutions. Seems simple, but it really isn't. That world is so complicated and has so many different groups in it. It's pension funds that invest directly or through larger investment management platforms. It's banks that often invest in real estate securities but do a ton of financing and lending, actual mortgage financing, and sometimes CRA capital and real equity in some transactions. It's the REIT community. It's investment management advisors. It's endowments like the Harvard Endowment or the Stanford Endowment. As it has capital, all of these entities have capital raised through various resources that they want to invest. So they're institutions. But it's not quite as simple as just saying, well, there's an investment manager who is investing money and I want to partner with them. It's important to understand the difference between discretionary money and non-discretionary money, because many of these entities are non-discretionary in how they invest their capital, and many investment managers have some discretionary capital and non-discretionary capital. And it's important for you as the potential operating partner or sponsor in a transaction or a portfolio effort to know the difference. Discretionary money means that the entity that's directly investing the money has the authority to invest it in accordance with an agreed upon investment strategy. So for example, Prudential would raise funds of capital from many, many pension funds, and they would be in commingled funds or sometimes separate account funds, meaning established just for that capital source, that pension fund, and had the right to make the investment decision without having to go back to the real provider of the money. That works really, really well when you are working with a firm like that, because that means they can make that transaction, they can make that decision relatively fast. Because non-discretionary money means that the party you're dealing with, that investment manager in many instances, and sometimes directly with pension funds who invest directly, they've got to go get a different approval before they can be committed to working with you. That can be troublesome because it gets in the way of deal timing. Everybody knows time kills all deals. If you have to have your partner go back to their capital source to get approval to move forward with you, that timeline can vary from 24, 48 hours to 2 weeks. Most smaller platforms don't have the latitude to allow for that. So you need to think about the capital that you want to partner with, whether it is discretionary, they make that decision for that investment, or non-discretionary. And that can be very important to your success and what you're trying to do. So then why? And sometimes I ask people who go, I really want to partner with institutional capital, and I have to go, why? Well, some of the answers are kind of obvious. More capital can lead to more growth of your platform, of your business, of your strategy. It is hard to do business and to grow where every deal has to find a new source of capital. It takes resources, it takes time, and it also takes away from your ability to continue to pursue new transactions because you're constantly trying to get them financed, invested in. Capital for every platform, ultimately, if well deployed, leads to growth. That's exactly why you want to go to institutional capital. There's also the prestige factor. The idea of being able to note that your partner or your investment partner or your entity partner is a well-known, well-respected, very large institutional capital provider will instantly add prestige to your platform. The ability to attract and connect and get commitment from these sort of entities is an absolute reputation enhancer for everybody involved. And it helps you with your transaction credibility, right? The fact that you have that capital, especially if it's discretionary, it means that you have more credibility of being able to get a transaction done. In my roles at Prudential, it was always important to understand where the capital was coming from on the other side of the deal. And knowing it came from a reputable, well-funded partner could make a huge difference in whether or not we would proceed to do a transaction with someone, especially if it was discretionary money. It will open doors. It will help get you into more deal flow because you've got the credibility of who you partnered with. And why would institutional capital even be interested in partnering with smaller platforms? And it really does come down to just three things: the hunt for yield, the ability to get involved in unique strategies, and deal flow. So the hunt for yield. Pension funds cannot live on 3% cash flows. Their outflow demands, their needs to meet the needs of their retirees, their pension fund, cannot survive on buying a bunch of core apartments in any major market at 3 and 4% cap rates. So there is a search for investment strategies that can provide higher yields. The other side of that, though, is that all of those strategies usually provide a lot more hands-on engagement than institutions can provide themselves. So that is an impetus for them to consider relationships with smaller firms, operators, people who are on the ground, actually seeing what's going on and able to recommend opportunities to these institutional investors that they might not otherwise see because you're on the ground and engaged in that marketplace very regularly. And you also can have unique strategies. A lot of pension funds kind of place themselves in the core plus world. Some of them are opportunistic on a smaller scale, but what they're often looking for is a way to find investment strategies that they haven't thought of themselves. I think one time during the early part of this decade, there was the whole discussion around condo deconversions. And that came up again after the financial crisis when you had condos that didn't sell. Well, that's a unique strategy in some places, but it requires execution by an operating partner who knows what that business is, can find those transactions, and can execute that strategy. And because pension funds, institutional capital, banks, REITs have so much capital, deal flow is something that's very important to them. They really don't want to get involved with platforms that can only provide a deal. The intent to create a relationship to facilitate this capital is intended to lead to multiple transactions. It's a lot of work. There's a lot of time. There's a lot of due diligence involved to create the relationship. And so the institution wants to know there's more than one deal. And to be able to get access to deal flow can be a real reason why institutional capital will consider investing and partnering with new groups. And from the new group side, probably the biggest thing about this is there's money there. The amount of dry powder sitting in the institutional capital space verges on $1 trillion around the world, if not more. That is money that has been earmarked to go into real estate and is still trying to find the right place to invest, the right partners to align with, the right opportunities to get them yield, to get them deal flow. There's plenty of money there. So absolutely, as a smaller platform, it's appealing. There are a lot of reasons why you would want to be engaged with institutional capital. So how do you do that? Well, I think the first step is outreach. It's knowing who is in that space, having them know who you are. It's attending conferences where there will be representatives from some of these larger institutional platforms and a way for you to do a warm introduction to them, looking at the directory of who's showing up at the conference going, I want to meet these people, reaching out to them saying, I see we're going to the same conference, I'm going to be there, I'd love to meet you, heard so much about you, love to understand what you're doing in your platform, and also let you know kind of what we're trying to do. Just an informational interview, probably is a good term for it. You got to be out there. They're not going to see you unless you're in front of them. It always helps, of course, if you know someone who works there and you can get a warm introduction to someone who's involved in the investment side of that platform, is involved in vetting and evaluating potential operating partners and sponsors. But you've got to make that effort. They will very seldom decide to come to you. You need to be able to differentiate yourself a bit. Why are you unique? Why is your firm unique? Why is your strategy unique? Why is your team unique and experienced and capable and has done this? You need to be able to show why you, of the 100 other firms that are probably reaching out to talk to them because they have capital, why they should talk to you. Now, I'm going to say sometimes there's really obvious reasons why they should talk to you, but you're going to have to be able to vocalize that and have a track record that you can show them where you've performed on the strategy that you're proposing to them, that your team has the experience and I like to say in kind of all cycles, although that's a little hard to do, but has experience in the down cycle, has been through the wars, through the most recent recession, whenever that might be, and has managed to come out on the other side with success, even if there are some hard lessons learned. It is really important to be patient. It is the rare situation that I'm aware of where a new operating partner sponsor has come in and been able to secure that sort of commitment for capital quickly. This is a relationship business. And a lot of times those relationships can happen in a couple months. Sometimes they can take a couple of years. But it's dutifully engaging with the institutional capital world while you are continuing to build and hone your expertise, your strategy, your experience while you are courting them. It's important to be patient. I would always recommend that you don't try to start this relationship in the throes of a deal. It's just not going to help you. It needs to be a supplemental part of your business development strategy is to create relationships and to better understand what institutional capital may be looking for, what that capital may need that you can provide, and work up and building their comfort that you are the party that they want to partner with. Transparency is incredibly important for institutional investors, and being able to be transparent with information about what you've done in your responses to their inquiries will make a big difference. Because all firms are going to do some degree of due diligence on you as part of their even considering what you've done. They're going to do a lot of checking, or at least they should, about your track record, about what you have done and what you haven't done, what successes you've had, what challenges you've had, and how you've come through all those. And I would say that coming out of the last recession, there was initially a lot of scrutiny behind looking at new potential capital partners, new operating partners for new investments, because so many operating partners pretty much disappeared when the market blew up in 2008. So their discernment about who they're going to spend their money with, who they're going to spend their time with, does require you as the potential partner to be thorough in your responses and fully transparent about your experience and about what your strategy is and how you've done it well and the lessons you've learned from the things you didn't do well. Or maybe it wasn't you, could have been a market. But if you're going to get in this space, I think there's a lot of work that as a firm you can do to be prepared and to be ready for an institutional partner, an institutional platform to say they want to engage with you and provide you with capital. And this is all really kind of your personal business operation platform that you've got to focus on making institutional ready. And that is to make sure you have policies for how you operate financially, how you operate from a management perspective, from property side, how you report your returns and report on how your properties are performing. It means that you have a business plan that you can share as to what you're looking to do, where you're looking to go. You've got a strategy behind that, who's going to be doing what, when, and where. You've got to be able to show your ability to accurately forecast your financial function, be it property financing or your business's financing and operations. So that capability and how you've executed in the past needs to be in place so you can share that. Asset management processes and policies. And I say asset management rather than property management, because if you are partnering with an institution, while many of them call themselves asset managers, you as the operating partner need to understand what asset management processes are versus property management, which is that day-to-day, make sure the lights come on kind of stuff. Asset management being above that, 10,000 feet above that, on more of a portfolio view, it is important to understand what asset managers want to know, what you need to stay on top of, what your policies are as an asset manager, because in some respects, you are an asset manager too. You are managing the investment of that money into a piece of real estate. And while you might not get paid as an asset manager, your understanding of what that involves will be incredibly important for your relationship with your capital partner. So bringing in experienced asset management talent can be very, very helpful here. As a firm, you also need to have a platform and a process around how you value your assets. Well, everybody goes out to get an appraiser, and institutions are third-party appraisal heavy. That is the model that they pursue, that they've got to have in order to have that third-party arm's length valuation of their assets. You need to have some too. You need to have some strategy around how you have valued your assets, who's doing it, how often it happens, how engaged you are or are not with that, so it is truly arm's length, but you have to have that in place because you will be part of that process for your partner. And GAAP accounting, I think a lot of smaller platforms don't think about this, but to have your accounting based on, GAAP requirements and consistent with the NAICS PREA reporting standards will go a long way for you to set yourself up to be able to provide the sort of accounting and accountability that institutions require. So through all that, we know why you want to do it. You want the money, you want the transaction credibility, you want the market gravitas to be able to get transactions and to grow your business. And we've talked about how you might get in front of institutional capital to even talk about who you are and what you're trying to do and why they want to partner with you. And you prepared yourself as an operation to be able to respond to and provide the sort of information that institutional capital wants to see. But why wouldn't you want to do this? And this is, I think, one of the hardest things to reconcile if you're really looking at institutional capital as being a way to grow your platform. Like, why not? It's money. It's all these great things for your platform. It does come with some challenges. Back to the timing problem. It takes a while to build the relationships that will get you to institutional capital. And if you are trying to get something done in the near term, this is not going to be the path that's really going to help you get there. Pursuing institutional capital for your platform is really something that should be looked at on a long-term basis. You're going to put a lot of effort into attracting and retaining and hopefully expanding that relationship. But it's going to take a while to get it started. And you're hoping that you'll have it for a while. So just put that in your mindset. I want to be here in 2 years. I need to start today in building the relationships that hopefully get me the capital that allows me to grow and execute the strategy. So in 2 years, I'm on the path that I want to be on. A lot of discretionary money won't give you discretion because they were delegated discretion from their capital. They will not undermine that discretion by giving it to a third party. So in some respects, while the capital you may be dealing with is discretionary, your relationship is non-discretionary. So you will always have to come back for some degree, expect to come back for some degree of approvals on new transactions because they can't let you just do that. I've heard of a lot of people talk about, well, I've gotten like deal, this is like a deal in a box model, meaning that I and my capital partner have come to an agreement on what kind of deals we're looking to do together. And so I am free to go out and find those transactions. That's where your discretion stops and starts. You are free to go out and find opportunities on behalf of this partnership that fit in this box, but there will be a checkoff, an approval process that you will likely have to pursue with the partner for their purposes. So think about control of that capital. Think about what that means for what you can do outward facing to the market. Think about what that means for how you will get deals approved internally. Most institutional capital partners are going to control major decisions. And major decisions, I've seen them in joint venture documents. They're 2 pages long. It's the sale of a major portion of an asset. It's the appraiser selection. It could be major leases. Things that would have significant impact on the value or the function of an asset are often going to be major decisions that your capital partner will control. Providing deference and input from you, of course, but at the end of the day, they are likely to be the ones who say we will or we will not do that. And if you like owning control, that can be challenging. One other challenge I've seen in the building up of relationships and the expansion of relationships between smaller platforms and institutional capital is the passage of time and the conflict of interests. Everybody's happy on day one. Everybody's excited about the transaction they're doing. But as a smaller operator, you may be influenced by the institution's change of strategy that is totally inconsistent with what you want to do. For any reason. I mean, it has nothing to do with you necessarily, but it does have to do with what's going on with them and their capital. And that can lead to some conflicting interests. They want to sell, you don't want to sell. You're not ready to buy them out. What do? You wind up having to sell. That can be a challenge. You're trying to build a portfolio. They're like, got that. It's just time for us to sell this. So if you can't take us out, we're taking it to market. There can be a misalignment of just expectations of what sort of returns are going to happen here, how this money is going to be distributed, what's going to happen at the end of the day, which deals are going to happen, which deals are not going to happen. In any partnership, you have those opportunities for interest slipping out of alignment, for there to be conflicts, for there to be expectations that are not met on one side versus the other. That happens in the best of relationships, right? But just be prepared. Institutions, while they love you and would want to be working with you for a long time, can have changes of heart for things that have nothing to do with you and can totally disrupt what you're trying to get done. So you just have to be prepared for that. Not to be distrustful, but to just recognize that institutional capital is not permanent capital for you necessarily.